The Fed officials have made it clear that they will not hurry in their decision to cut the key interest rate. This could be explained by the recent inflation surge. By the way, the macroeconomic reports issued this week, including retail sales, initial unemployment claims, and the fully fed manufacturing PMI, are reflecting U.S. economic stability and ongoing price pressure. The new week is expected to provide traders with more accurate information on business sentiment in the largest economies. We are going to find out what macroeconomic reports should be taken into account when developing trading strategies. You are watching a video review of the macroeconomic events. The beginning of the week is likely to be calm for investors. On a Monday, the macroeconomic calendar is empty. However, on Tuesday, traders will have to digest the bulk of the information. Thus, the news flow will be launched by Japan. The yen continues to experience difficulties despite all the efforts of the local authorities. Finance Minister Shinichi Suzuki held an unprecedented three-party dialogue with the Treasury Secretary Janet Yellen and his Korean counterpart. As a result, the U.S. acknowledged the grave concerns among Asian countries about the slump in their currencies. On Thursday, Bank of Japan Governor Katsuo Ueda said that the central bank could raise interest rates again if the yen's decline significantly spurred inflation. Ueda's comments came before the Bank of Japan's monetary policy meeting, which is scheduled for the next week. On a Friday, the data showed that Japan's core inflation slowed to 2.6%. Against this background, fresh data on business sentiment may support the currency. Notably, Japan's manufacturing activity contracted at a slower pace in March, while further expansion in the services sector supported overall growth, with the indicator reached 54.10 points. If the fresh data shows an increase in business activity, the yen may rise. At the same time, it should be noted that the currency movement is also influenced by geopolitical tensions and the expectations of the Bank of Japan's rate decision at the end of the week. Also, on this day, the Eurozone will disclose its business activity figures. In March, the indicator increased for the first time since May 2023, although the composite PMI rose. All other indicators showed mixed results. In other words, the services PMI advanced more than anticipated, while the manufacturing sector reported a deeper drop. As a result, the composite indicator was up to 50.3 points in March from 49.2 points in February. The indicator exceeded the 50-point threshold that separates expansion from a contraction. The signs of recovery in a business sentiment after an 8-month drop supported the euro. However, it's not clear whether the trend will continue. If the composite PMI slides below 50 points, the euro will experience pressure. Otherwise, the single currency will continue gaining in value. During the US session, traders will take a look at the business sentiment figures from the United States. Notably, in March, the rise in the services sector slackened even more, whereas the price that businesses pay for resources fell to a 4-year low. In the previous months, the non-manufacturing PMI declined to 51.4 points from 52.6 in February. Then, analysts explained that growth slackened after the key interest rate hike by the Fed. The services sector is the main inflation driver because of higher salaries. That's why traders are likely to pay close attention to the expected report. Meanwhile, the manufacturing PMI stayed at 51.9 points, whereas the composite PMI was at 51.10 points. Thus, the overall data pointed to economic stability in the United States last month. US business sentiment is better compared to Europe. According to the forecast, the indicator may increase, taking into account the recent Fed's comments that the existing economic conditions allow them not to raise the benchmark rate. Strong data may push the greenback. In the middle of the trading week, traders will shift their attention to Australia and its national currency. During the Asian trading session, traders will be able to assess fresh inflation data. In the previous months, a report from the Australian Bureau of Statistics unveiled that the monthly consumer price index rose at an annualized rate of 3.4% in February, unchanged from January. In addition, Australia's inflation rate was 4.1% in the fourth quarter of 2023, up from a year earlier. At that time, analysts speculated that even though inflation had bottomed, base effects could allow it to resume rising in the coming months. If price pressure picks up, the Australian dollar will get support, while softer data could lead to lower bets on a Reserve Bank of Australia rate easing. Traders may also focus on the durable goods orders data from the United States. In February, the index exceeded the forecast, while business spending in equipment showed tentative signs of recovery. Orders for non-military capital goods, excluding airplanes, which are an indicator of business spending plans, rose by 0.7% in February after a 0.4% decline in the previous months. The overall indicator of core orders advanced by 0.3%, and the rise in durable goods orders partly offset January's sharp losses, meaning that the industry may be recovering from difficulties amid the Fed's interest rate hikes. Given the latest U.S. inflation data, fresh readings may be less rosy. If the data is weaker, the USDX may experience a short-term pressure, while a stronger report would support the index. This was a brief overview of the key macroeconomic events from InstaForex analysts. Keep an eye on the data releases to open the best trades. We wish you profitable trading. Stay tuned.